Welcome to 12th PUC Accountancy NCERT syllabus. Today we are going to start up the first chapter, Partnership Accounts Basic Concepts. So what do you mean by partnership? It is covered under the Partnership Act 1932 when two or more persons combines together to form a business to share profit and losses based on the agreement made by them. So let us go with the features. So it is covered with Partnership Act 1932. So whoever wants to convert this business from sole proprietorship to partnership firm, they should have a minimum of 2 or more numbers. Secondly, they should agree with a valid oral or written agreement mutually made by them. Thirdly, they should agree to share the profit as well as the losses whichever accrued from the business based on the agreement contract. Fourthly, their liabilities are limited to the extent of agreed agreement. Based on these basic concepts, today we are starting the topic called interest on drawings. What do you mean by drawings? Any idea? See, the drawings is nothing but the value drawn by the partner within the stimulated period during the financial year. So the financial year begins from 1st April to the 31st March of every year. If a partner due to an emergency, if he withdraws any part of his capital, as per the Partnership Act 1932 and the partnership deed, he has to pay an interest on his drawings whatever he draws. So this is treated as an indirect income to the firm and indirect expenses to the partner's account. So to calculate interest on drawings, there are two methods. One is direct method and one more is product method. So these two methods have a proper weightage on your exam point of view. Let us go with a practical sum. Calculation of interest on drawings with direct method. So under direct method, we have to go in with directly with the dates and the amount which he has withdrawn. Let us have an example. See, there is a partner who has withdrawn simultaneously 4 times in a particular year. That is, he has withdrawn on 31st May, 30th September, 31st December and 1st March of next financial year. And he has withdrawn a drawing equal amount of 5,000 each time for 4 multiple times. And as per the agreement, it is charged with 12% per annum. Please do remember, this is for 12% is for per annum. Yearly interest rate which he has to pay. Okay, so as I told, the accounting period for this will be starting on 1st April 2025 to 31st March 2026. Is it clear? So the accounting period starts from 1st April 2025 to 31st March 2026. So let us see that. The format is very simple. You have to draw a 5-column table with date of drawings, the drawing amount made by the particular partner, and do remember that if you have a 2 or more partners withdrawn in a particular year, you have to calculate it separately. You are not going to club anybody there because the date may mismatch. Next, drawings amount what the partner has withdrawn in the 4 times and the rate of interest applicable as per the agreement made. And the next 2 columns, this is your question part and the answer part is due months and interest value. So what do you mean by due months? So when he has withdrawn a part of amount at a particular date, from the date of drawings to the end of the accounting period, that is 31st March, how many months he has to pay the interest? So let us start with first one. He has withdrawn on 31st May and the accounting period on 31st March. From 1st May to 31st March, how many months are there? So you have to assume like May, June, July, August, September, October, November, December, then January, February, March. So it is 10 months. So 10 out of 12 months. Am I clear? Next, he has withdrawn on 30th September. So 30th September, we are not going to consider the September year because he has withdrawn at the end of the month. So we have to calculate from the October month. From October to 31st March, it is 6 months. And thirdly, he has withdrawn on 31st December. Again I am repeating my words. December is not counted because he has withdrawn at the end of the month. We have to start from the January. So it's January, February, March. It is 3 months out of 12 months. And lastly, he has withdrawn on 1st March. So 1st March to 31st March, there is a gap of only 1 month, which I am going to consider that. So I will repeat again. From May to March, it is 10 months. From September end to March, it is 6 months. And 31st December to March, it's 3 months. And 1st March to 31st March, it is 1 month. Am I clear? Now, to calculate the interest, let us have one small working here. So it should be interest is equals to drawings amount, that is 5,000, into 12%, that is 12 by 100, into due months. So the due months is 12 by 12 for each thing. So 12 and 12 will be cancelled, 0 will be cancelled, and 0 will be cancelled. So you will be getting 500 as a answer. So first month it is 500 rupees, and second month it is again 5,000 into 12% into 6 by 12. 12, 12, 0, 0, 0, 0. So it is 50 into 6, it will be 300. And then thirdly, 5,000 into 12% into 3 by 12. 12, 12 is cancelled and this cancelled. 3 into 50, it is 150. And finally, the last person, 5,000 into 12% into 1 by 12, the last month. So 12 is cancelled, 0 is going out, so it's 50. So the first month interest will be 500, and second month 300, and the third month 150, and last month 50 as per our calculations. So the total drawings will be 500 plus 300 800 plus 150 950 plus 50,000 rupees. Is it clear? So this partner who has withdrawn the equal amount in 4 equal installments during a month, and the payable interest is 12%, then he has to pay 1,000 rupees in a particular year, and which you have calculated under direct method. So now we are moving to the product method with the same data, and make sure that either you make it on direct method or in product method, the interest on drawing should be equal. Do remember that we have got here 1,000 rupees under direct method. The same data with product method we are going to do now, and the interest on drawing should be same 1,000 rupees. Let us go to the next method. So I have a data here, the same person, same date, 31st May 5,000, 30th September 5,000, 31st December 5,000, and 1st March 2026 5,000, and the interest rate is 12%. So let us conclude that we have only 2 inputs here, where we have 3 inputs in our direct method. We are ignoring the rate of interest column here because we have nothing to do with the rate of interest now. Presently, we have to go it later. Okay, let us start with due months. Again, I repeat the words. The account starts from April to March. I have withdrawn the money on 31st May, so May is not considered. So from June to March, it will be 10 months. Again, September 30 we are not considering. From October to March, 6 months. 31st December we are not considering December, and it will be January, February, March, 3 months. 1st March to 31st March, 1 month. Now, product is nothing but drawings into due months. 5,000 into 10, it will be 50,000. 5,000 into 6, 30,000. 5,000 into 3, 15,000. 5,000 into 1, 5,000. So this will be your total product value. I repeat my words, 5,000 is the drawings and is the number of months are 10. So I have to multiply under product method, 5,000 into 10, 50,000, 5,000 into 6, 30,000, 5,000 into 3, 15,000, and lastly 5,000 into 1, 5,000. So 50 plus 30, 80, 95, the product will be 1 lakh. So how to calculate the interest now? Interest on drawings is equals to, the formula is very simple, total product into rate of interest into 1 by 12. What is this 12? Product, the value which we have multiplied and we got in the previous step is called total product, and the rate of interest is the interest which is as per the agreement which he is going to pay for his drawings, and that 1 by 12. 12 is nothing but how many months are there in a year. Now we'll go with it. So total product is 1 lakh into rate of interest is 12%, that is 12 divided by 100 into 1 by 12. Total product is 1 lakh, rate of interest is 12 by 100 and the number of months are 12. So let us conclude. 12 cancelled, zeros are cancelled. It will be 1000 into 1, 1000. So are you clear now? Under direct method, we have multiplied and we got 600, 300, 150 and 50, which is amounting to the 1000 rupees. Again, the same data we are putting on the product method, again we got the same amount. That means it is clear that whether you opt direct method or indirect method, the answer what you are going to calculate on interest on drawings will be similar. Okay, just now we learnt about interest on drawings, where interest on drawings made by a partner in a particular year will be treated as an income to the company and expenses to the partner account. Now we will move with the profit and loss appropriation account. You people have heard about the profit and loss account. Profit and loss account is nothing but the recording of expenses and incomes made during the year by the company, which determines you the output as net profit. Now, with the net profit, whatever the partnership firm earn, they have some other expenses and incomes which is related to the partners. I repeat, it is only related to the partners, not to the business. The expenses and incomes related to the company will be recorded in P&L account, whereas only the partners related expenses and incomes will be coming under profit and loss appropriation account. It is mandatory under Partnership Act 1932. So the partners' expenses and incomes are recorded. Let us have some examples here. When you say income under the partners account related to the partners is IOD, that is interest on drawings. So previous sum, whatever we calculated, that is an income to the company, and this should be recorded in the credit side of the P&L account. And when I say expenses, we have only three. One is IOC, and second salaries, and third commissions or brokerages. What is this IOC? As per Partnership Act 1932, when a partnership firm is entitled to receive the interest on drawings made by the partner, again this act clearly says, as per the agreement, a firm has to pay the interest on capital 2, which is specified under deed. And as per the act, if the interest on capital is not specified, the default percentage is 6% per annum. I repeat again, if your agreement does not specify the interest on capital, the default percentage is 6% per annum. So interest on capital is an expenses to the firm and income to the partner, which is recorded in the debit side of the profit and loss appropriation account. And then what is the salaries? So salary is not to the employees. Some partners are entitled to get their salary as per the deed, because some partners are treated as working partners. They contribute their contributions to the partnership firm to achieve the profit. And commission, again it is not to the agent, it is again to the partner who is entitled not for the salary but for the commission purpose. Let us go with the partners P&L appropriation account. The format is very clear. It's a profit and loss account format. Particulars amount. All the expenses will be recorded on the debit side and all the incomes will be recorded on the credit side, which we starts with net profit earned from the profit and loss account will be recorded here. This net profit is nothing but the accumulation made from trading and profit and loss account of your firm. Then the only one income other than net profit will reflect on the credit side is IOD, that is interest on drawings. The drawings interest which is accumulated from the direct method or product method. And maximum 3 expenses will be available in your profit and loss appropriation account debit side. To interest on capital as per the capital mentioned, and the commission paid to partner and salary paid to partner. It may be monthly or yearly, whatever it may be, and commission also it may be monthly or yearly, whatever it may be. Okay, let us have a small assignment. The company earned a net profit of 60,000 in a year with the capital contribution by A at 1 lakh and B with 1 lakh. And as per the agreement, interest is payable on capital at 10% per annum, and A is entitled to get 1,000 rupees per month and B is getting a commission of 2,000. So when it is clearly mentioned 2,000 and they never mention whether it is a monthly or yearly, you should consider it as per annum. And interest on drawings, they have mentioned you the value itself. So A has withdrawn and he is entitled to give 500 rupees as a interest, and B is withdrawn and he is entitled to pay 500 rupees as a interest. Now, can we do the sum there? Let us go and concentrate on the income of the firm. It will be by net profit carried down. As per the statement, it is 60,000, and next is by interest accumulated on drawings. So we have A with 500, B with 500, total is 1,000 rupees. This side we have interest on capital. Hope you remember, A has invested 1 lakh into the firm with 10% as interest on capital. B again same contribution of 1 lakh with 10% capital. So it will be 10,000 and 10,000 equally between A and B. Then A's salary, so it's clear that they have mentioned 1,000 per month. So 1,000 rupees into 12 months, which will come across 12,000, and to B's commission. So they have mentioned is at just 2,000 per annum. So we have, as I told, there will be 2 maximum incomes and 3 maximum expenses are there. So when we consider this, the total is 61,000 on the credit side. As per the accounting principle, ledger accounts, the total of the debit and credit should be equal, 61 and 61. So 34 is going out. 27,000 is the remaining. We can call it as to profit transferred to, it is not going to balance, it is going to partner's capital account. So this 27,000 accumulated, see, the profit as per net profit is 60, from which partner's expenses and incomes are concluded. The actual profit going to the next step is 27,000, and this 27,000 will be distributed to A and B as per the profit sharing ratio or equal ratio or capital ratio, whatever is mentioned in the agreement. Hope you understood this profit and loss appropriation account, which carries a compulsory question in your examinations point of view. So I repeat my words, there are maximum 2 incomes on the credit side and there will be a maximum of 3 expenses on the debit side. Net profit brought from the profit and loss account and the interest on drawings will be on your credit side. Interest on capital as per agreement if mentioned, and the salaries to the partner and commission to the partner will be on the debit side. The excess of the difference will be either the profit transferred to the profit and loss account or loss transferred to the profit and loss account. Thank you.